You know, when we talk about investing, the word patience can mean a lot of different things. But what if it meant you couldn't touch your money for over a decade? Today, we're diving into the worlds of private equity and private credit, and we're going to see just how different their clocks are really ticking.
I mean, it's a totally fair question, right? We live in a world where you can buy and sell stocks in a split second. So the idea of committing your capital for 10 plus years, it seems almost crazy. But in private markets, that's just the price of admission. And understanding why comes down to one really simple concept. And that concept is the investment horizon. All it means is the total amount of time you expect your money to be tied up. In the public stock market, hey, your horizon could be 30 seconds. But in the private markets, it's a serious locked-in commitment you make on day one. And that changes everything. The reason for this big commitment is that we're dealing with assets you just can't sell easily. They're illiquid. Once your money is in, you can't just pull it out whenever you feel like it. So that investment horizon, it's not just a guideline. It's one of the fundamental rules of the game.
Okay, so to make this super clear, let's think of these two as characters. First, you've got private equity. Let's call it the builder. Its whole job is to buy a company, roll up its sleeves, make it better, and then, years later, sell it for a big profit. And then you have private credit, who we'll call the lender. The lender isn't buying the whole business, it's just lending it money and collecting interest payments. See, two totally different jobs, and as you'll see, two very, very different clocks. Let's start with our builder. Private equity is all about playing the long game, and it has to be. You need a ton of time to find the right company to buy, to actually implement all your improvements, and then to wait for the perfect moment to sell. You can't just flip a company overnight. And that long game has a number. Yeah, we are talking about 10 to 12 years. Seriously, just let that sink in for a second. That's not just some random suggestion, it's baked into the very structure of how these things work. And the reason for that long wait is all about the journey the investment takes. So this decade-long journey basically happens in 3 stages. For the first 5 years or so, the fund is just raising money and buying companies. Then comes the real work. The middle chunk of time, years 3 to 7, is all about getting in there and actively making those businesses better and more valuable. It's only in that final phase, from year 7 on, that the fund can finally start selling off its improved companies and hopefully realize some big returns. So the key thing here is that the payoff is way at the end after a long, deliberate process. And get this, 12 years isn't even the final word. If the market stinks and it's not a good time to sell, the fund managers can often extend the fund's life, sometimes up to 16 years or even more. See, for them, it's all about getting the absolute best price, not just hitting some arbitrary deadline, which means for the investor, well, you've got to be even more patient. All right, so we've met the slow and steady builder. Now, let's completely switch gears and talk about our other character, the lender. With private credit, we're entering a totally different universe. The goals are different, the strategy is different, and as you're about to see, the clock is running much, much faster. And wow, look at that contrast. Instead of a decade or more, we're suddenly down to just 3 to 7 years. That is a huge difference. We're going from a truly long-term commitment to more of a mid-term one. So the big question is, how on earth do they pull this off so much faster? Well, it all comes down to their fundamental game plan. A private credit fund isn't trying to rebuild a company from the ground up. They're just lending it money. Their profit doesn't come from some massive sale at the very end. It comes from those steady, predictable interest payments they collect along the way. The loans themselves have shorter deadlines, and the whole goal is to generate income. So a shorter timeline isn't just a nice to have, it's the whole point. Okay, so we've got our two players, right? The builder, who's playing the long game of transformation, and the lender, who's focused on that midterm income. Putting them side by side really makes their differences pop. I mean, the comparison is pretty stark. Private equity is all about creating value, which leads to a big one-time payout when they sell. Private credit is all about generating a steady, consistent income stream. And that one single difference in their primary goal dictates absolutely everything else, from how long your money is tied up to how you actually get paid. It really boils down to this. Are you waiting for one massive payday at the very end, or are you collecting smaller, regular paychecks along the way? So after looking at these two really different worlds, what's the one thing you should remember from all of this? What's the main lesson here? It's this. The investment horizon isn't just a minor detail, it is the strategy. A long timeline is what makes the whole builder model possible. A shorter timeline is perfectly designed for the lender and its income-focused goal. So before you ever think about putting a dollar into any private fund, the very first question you have to ask yourself is, how long am I truly okay with this money being locked away?
And honestly, this idea goes way beyond just private markets. It doesn't matter if you're looking at a huge fund or just buying a single stock. The first question is always the same. Knowing your personal investment horizon is the absolute foundation of any good strategy. So before you do anything else, what's yours?